Market volatility is one of the most stressful parts of trading. Prices move fast, candles become large, news appears suddenly, and emotions rise quickly. Even traders with experience can feel overwhelmed during volatile markets. In this video, I want to explain how to stay calm during market volatility. Not by avoiding the market, not by pretending volatility does not exist, but by understanding why volatility creates emotional pressure and how professional traders remain calm even when the market feels chaotic. If you stay with me until the end of this video, you will understand what volatility really is, why it triggers fear and impulsive behavior, and how to train your mind to stay stable when markets are moving fast. This video is designed to be watched slowly, from start to finish. Each idea builds carefully on the previous one. If you are serious about trading psychology and long-term consistency, consider subscribing to Bull Mindset. This channel is about helping traders think clearly, stay disciplined, and remain calm under pressure. Now, let us begin. The first thing we need to understand is what market volatility really is. Volatility is simply speed and range. Prices move faster, moves become larger. Uncertainty increases. Volatility itself is not good or bad. It is just a condition of the market. But the human brain reacts strongly to volatility. Why? Because volatility increases uncertainty, and uncertainty triggers fear. The brain wants stability. It wants predictability. Volatile markets offer neither. So when volatility increases, the brain goes into protection mode. It tells you to act quickly. It tells you to avoid risk. It tells you to secure profits. It tells you to escape danger. These reactions are automatic. They are not signs of weakness. They are human survival responses. The problem begins when traders let these reactions control behavior. Professional traders understand this. They do not try to remove volatility. They do not try to fight it. They focus on controlling themselves. Staying calm during volatility is not about confidence. It is about preparation. Most traders feel panic during volatility because they are mentally unprepared for it. They expect markets to move smoothly. They expect clean setups. They expect normal conditions. When volatility appears, expectations break. Broken expectations create emotional shock. Professional traders expect volatility. They know it will happen. They prepare for it in advance. This expectation reduces emotional surprise. Another reason volatility creates stress is unclear risk. When markets move fast, losses can increase quickly. If risk is not clearly defined, fear increases. Professional traders always know their maximum loss, even during volatile conditions. This clarity protects the mind. Another reason traders lose calm during volatility is overexposure. Too many positions, too much size, too much screen time. Volatility amplifies everything. If exposure is too high, emotions will be too strong. Professional traders reduce exposure during volatility. They do not try to prove anything. They try to stay stable. Now, let us talk about how volatility affects behavior. One common reaction is panic exits. A trader enters a trade. Price starts moving fast. Candles become larger. Fear appears. The trader exits early, even if the setup is still valid. Later, price moves to the target. Frustration appears. Another common reaction is hesitation. A trader sees a valid setup, but volatility makes the market look dangerous. The trader waits. Price moves without them. Regret appears. Another reaction is overtrading. Volatility creates excitement. Traders feel the urge to participate. They take trades without proper setups. Losses follow. Another reaction is freezing. Traders feel overwhelmed. They stop making decisions. They miss opportunities. All of these behaviors come from emotional overload. Professional traders avoid these reactions by simplifying decisions. Now let us talk about how professionals stay calm during volatile markets. The first thing they do is accept volatility. They do not expect calm markets all the time. They understand that volatility is part of trading. Acceptance reduces resistance. Resistance increases stress. The second thing professionals do is reduce risk. They trade smaller during volatile conditions. This is not fear, this is intelligence. Smaller risk allows clearer thinking. Clear thinking leads to better decisions. The third thing professionals do is slow down. They do not rush decisions just because the market is moving fast. They pause. They follow the same process as always. Speed in the market does not require speed in decision-making. This is a critical mindset. The fourth thing professionals do is narrow focus. They avoid watching too many instruments. They avoid too much information. They reduce noise. Noise increases emotional load. Now, let us move into real trading examples. Imagine a trader during a high volatility session. Price is moving quickly. News is coming out. The trader is watching multiple charts. Emotions rise. They take trades impulsively. losses increase. Now imagine another trader. Same market, same volatility, but this trader is prepared. They already reduced position size. They already accepted risk. They focus only on one setup. They wait patiently. They take fewer trades. Their behavior stays calm. Same volatility, different mindset. Another example is managing open trades during volatility. A trader is in profit. Volatility increases. Price pulls back sharply. Fear appears. The trader exits early. Later, price continues in the original direction. Professional traders expect pullbacks during volatility. They do not react emotionally to every move. They trust their plan. Another example is avoiding trades. Sometimes, staying calm means not trading. Professional traders know when conditions are not suitable. They do not force participation. They protect capital and mindset. Now let us talk about mental frameworks that help during volatility. One important framework is control versus acceptance. You cannot control the market. You can control your behavior. Professionals focus only on what they can control: risk, execution, discipline. This focus reduces anxiety. Another framework is probability thinking. Volatility increases randomness. Professionals do not try to predict short-term moves. They think in probabilities. This reduces emotional attachment to outcomes. Another framework is neutrality. Professionals aim to stay emotionally neutral. They do not celebrate volatility. They do not fear it. They treat it as information. Now let us talk about practical exercises to stay calm during volatile markets. One exercise is pre-session preparation. Before trading, remind yourself that volatility may appear. Expectation reduces shock. Another exercise is risk adjustment. Reduce position size intentionally during volatile sessions. This creates emotional safety. Another exercise is breathing awareness. When volatility increases, slow your breathing. Slower breathing calms the nervous system. Another exercise is decision delay. When you feel urgency, delay action slightly. This pause breaks emotional reactions. Another exercise is post-session review. After volatile sessions, review behavior, not profit. Notice how you reacted emotionally. Awareness builds control. Now let us slow down and connect everything. Market volatility is unavoidable. Trying to avoid it creates fear. Trying to control it creates stress. Professional traders stay calm by controlling themselves. They prepare mentally. They manage risk. They slow down. Calm is not the absence of volatility. Calm is stability within volatility. If this video is helping you think more clearly about volatile markets, consider subscribing to Bull Mindset. This channel exists to help traders stay disciplined, calm, and consistent under pressure. Let me leave you with a final thought. Volatility tests your psychology, not your strategy. When you learn to stay calm, volatility becomes manageable. Trade calmly, trade with discipline, and think long-term. I will see you in the next video. Thanks for watching.